What is up, everybody? It's Guy Costin, and I'm here to tell you about the Dakota Way Allocator Conference. This is a conference you are not going to want to miss. We have some of the most insane allocators and executives speaking, including Lawrence Calcano, CEO of iCapital, Mark Beagle, CIO of the private markets team of Corio. We have longtime alts allocator Bob Shear from the Greystone team. This is going to be an unbelievable group of people from Cerity and others. We're going to keep rolling out these allocators, these interviews. They're going to share insane insights. I'm going to do a little promo of the book and talk about the sales best practices. Plus, there's going to be an enormous amount of networking time. But I know what you guys want. You want to hear from the allocators. You want to hear what money's in motion. We're going to deliver that to you on May 19th, Pier 60 in Chelsea Pier. So May 19th, Chelsea Piers, Pier 60. Register now at Dakota.com. There's a button right on our homepage. It's incredibly easy to register. This is not a conference you're going to want to miss. Register at Dakota.com.
Welcome to the Dakota Research Podcast. This podcast is for informational purposes only and should not be considered investment, legal, or financial advice. The views expressed are those of the speakers and do not necessarily reflect the opinions of Dakota or its affiliates. We do not provide investment recommendations or solicit investments in any securities or funds. Listeners should conduct their own research before making any investment decisions.
Welcome back, everybody, to the next episode of the Dakota Research Podcast. We have episode 10 today. We've got a lot to cover. There's a lot in the news to discuss. A lot going on in the world, too, including tariffs, which seems to be the topic du jour. It's impacting the private equity industry significantly, would be kind of an understatement, I believe. Yeah. But today we're going to bring you our normal segment where we'll cover private equity news and trends, including fundraising highlights, deals, and people news. A deep dive discussion today will be focused on the consumer sector. And then insights and actions. So upcoming events, show notes, and Q&A. For all of those that are listening today, please log in your questions to the live chat. We'll get right back to you. We appreciate the interest and joining us for today's show. Let's kick things off with the news highlights. So some news out of Goldman Sachs. They are launching a private equity fund for wealthy investors. This is an open-ended private equity fund that will seek capital from the high net worth channel. The fund will be offered to individuals with a minimum investment of $5 million across their portfolio. The report noted that we saw, and Goldman Sachs intends to launch the fund as part of a G-branded series differentiating asset class targets such as infrastructure, real estate, and private credit. GPE will offer investors access to deals from Goldman's buyout, growth, and secondary and co-investment strategies. The lender is looking to attract capital for its suite of funds from clients through wealthy brokers and private banks. This is part of Goldman's strategy to grow its alternative investment distributed through third-party wealth platforms to $8 billion in 2025 from $5 billion in 2024. Why it matters, we've been talking a lot about this trend on the show, new wealth investor products that are private equity focused. So targeting the high net worth channels with an open-ended structure is a signaling trend towards liquidity focus on alternative products. So well-known brand investment franchise sounds like it's growing pretty significantly, targeting $8 billion in assets in 2025. So something to keep an eye on there.
Yeah, I don't think it should be very much of a problem given their scale. I mean, the private banking platform at Goldman Sachs is pretty massive. So, and all of those people that are private banking clients, these high net worth individuals, obviously this is the product for them. They want exposure to alternatives. So Goldman is providing a solution there.
And they've got a toolkit, so direct deals across the asset classes, being able to fit right into client portfolios in a nice, neat line item offered to their clients, perhaps other clients too that are interested in the product. Might be a on-ramp to their broader wealth advisory practice too. So again, a product that differentiates themselves from others that don't have products available on their platforms today.
Yeah, we have a similar story coming from HarbourVest Partners as well. So they recently launched a $500 million private investment fund. They were registered with the SEC at the beginning of this month and submitted a prospectus last month. So the fund's objective is to generate long-term capital through exposure in a portfolio of assets from different geographies, sectors, and stages. This is an evergreen fund. It's going to be structured as a closed-end fund, as it's going to be offered to sort of similar clientele as the Goldman product we just discussed, sort of these high net worth wealth investors in that channel. There'll be 3 different share classes as well. There is seed capital sort of already in the strategy, so we kind of know through the public filings what the fund is like from a construction perspective. So right now, the fund launched with exposure to nearly 40 companies in the portfolio, and then alongside that, 30 private equity managers. So it looks like there's going to be some direct investments as well as some fund investments to add some diversity there, which is great. The fund's going to target, like I said, direct company investments in the small to mid-market segment, as well as sort of fund investments with some top-tier sponsors. Again, similarly, why this matters, we talked about it earlier, but we've talked about it all the time, but just providing these offerings to the high net worth wealth channels, giving them access to alternatives in an easy to invest, diversified manner.
Absolutely. And I think another key point too is that it's not a blind pool like traditional private equity. So the underlying investments, there's no capital calls, so you get your capital deployed rather efficiently. You have a partner like HarbourVest, which is one of the largest fund-to-funds players in the U.S.
And no K1s.
And no K1s,
we've heard they've becoming more and more annoying.
Yes. So for advisors, folks in the wealth management industry that are looking for different solutions to bring on alternatives in their platform, this could be a solution for them here again. And with a group like HarbourVest, as I mentioned, they have a tremendous amount of data that at their fingertips and have covered a lot of fund strategies, can assemble a diversified portfolio, not just both here in the U.S., but outside the U.S. opportunities as well. Yep. Moving on to our fundraising highlights section. One piece of news to call out, Investindustrial. They closed their 8th flagship fund above target, which was at 4 billion euros. The target for the fund originally was 3.75 billion euros. Investindustrial 8 received commitments from new and existing investors with the re-up rate higher than previous commitments. The investor base of the fund includes pension funds, insurance companies, sovereign wealth funds, banks, endowments, foundations, fund of funds, and family offices primarily in Europe and North America. Dakota data shows the fund attracted commitments from the Ohio Public Employee Retirement System, Florida State Board of Administration, Employees Retirement System of Texas, California State Teachers Retirement System, University of Michigan Investment Office, and State of Wisconsin Investment Board. That's quite a list of large allocators here in the U.S. The investment vehicle will target high-quality Southern European mid-market businesses. Again, a growing trend. We have our allocations report coming out, and that's one of the key trends within buyout, capturing a lot of the flows, but mid-market continue to be a key focus area for these groups. With mid-market businesses with global revenues and growth potential employing a buy and build strategy. The group buys majority or control positions in mid-market companies. Why it matters, high rate of returning LPs and major U.S. pensions and endowments involved, so there's credibility from existing and new investors. Also indicates credibility and robustness of the investment thesis and confidence in the European markets, which today, given kind of the tariffs, you think about some of the dislocation going on in the public markets, probably in the private markets as well, more opportunities further down market to exploit and capture and add value to.
Yeah, I mean, we've seen it in sort of the listed markets. There's a lot more allocations pivoting to sort of international strategies across all caps, whether small cap, mid cap, large cap, value and growth, more allocations to global international strategies. It looks like these U.S. pensions on the private side are getting a lot more confidence in investing in buyout strategies on the private side in sort of these European markets. So looking to diversify as much as possible.
Yeah, diversification is key. It seems like people are thinking not just we continue to allocate to private markets, but we're also allocating within the asset classes in a broader, more diversified fashion. Yeah. And that goes across both buyout, but also private credit and venture, and both geography and sector too as well.
Yeah, and speaking of diversification, Pophouse Entertainment, another European investment firm, they closed their debut music fund at 1 billion euros, actually 1.2, pardon me. This included 200 million euros in co-investment as well. So yeah, Pophouse Entertainment received commitments from a pretty diverse group of investors, pension funds, endowments, high net worths, family offices, sovereign wealth. So really collecting funds from a really diverse group, which is great to see for a first-time fund. So this investment vehicle is pretty interesting. So it targets opportunities in sort of music catalogs and sort of IP, allowing it to further grow its network of partners, which already includes some pretty notable names that you probably have heard of, such as Kiss, the American rock band. Love them. Swedish EDM artists, Avicii and Swedish House Mafia.
Yep.
That's pretty interesting as well. And at closing, the music fund's already 30% deployed, so really actively investing already, despite just closing. Pophouse Entertainment was founded by ABBA's Bjorn Ulvaeus and Connie Jansson, the founder of Swedish investment group EQT. So the fund employs a strategy focused on investing in publishing rights, recording rights, and name, image, and likeness rights. So thinking about why this matters, we touched on a little bit with sports, but investors are looking to diversify outside some of the traditional asset classes. So with the example you just spoke to, obviously diversifying from a geographical perspective, but also looking at these more alternative investments to diversify sort of maybe outside traditional buyout or traditional private credit. I think what's nice about sort of these entertainment assets and sort of the attractiveness of IP is just like a steady return generator, can kind of be insulated from what's going on in the broader economy.
Absolutely. And I think one of the questions that investors typically ask when meeting with these royalties groups is, where do I put it? How do I bucket it?
Yeah.
Is it private credit? Do I have a royalty sleeve already existing? Maybe it goes alongside mineral oil and gas royalties in some fashion, or some other type of royalty strategy, or some type of asset finance type strategies, or maybe it goes in kind of my hedge fund bucket. Like, investors are kind of trying to understand, they're attracted to the asset class because of the uncorrelated returns. Obviously, too, here you have PE guys from EQT that are interested in the asset class from a personal investment perspective. So they see the opportunity, the high return potential, and the uncorrelated returns all kind of packaged into one is an interesting aspect to add to the portfolio to increase that diversity. But then, new investors, as they come along and continue to kind of think about other ways they can create high returns, this might be an area of interest. I know we're going to hopefully speak to a couple of firms in the space upcoming in in an interview, but to learn more about it and get more in the weeds. But it's pretty fascinating what these groups do. I mean, aside from just being, structuring a financial transaction, the level of detail that goes into understanding how all those, with the booming, growth of streaming, and also media and music being used in movies and the like, commercials, etc. Like, how are they collecting all these revenue streams and this from the sync and all these things? So it's very complex, but there's a lot of different groups that are niche players in the industry that like basically help end-to-end groups like this manage that process. And those private equity firms are really in tune with not only finding the sourcing. You imagine trying to buy a catalog for like Kiss or Swedish House Mafia or Avicii, and these are kind of top tier catalogs. How do they get access to them? Who owns the deals? Or is it still owned by the artists themselves? Is it owned by somebody else? How to structure the deal, and then how to add value from there is really interesting to follow.
Well, we're going to have to save those questions for another time, because it sounds like we're going to have someone in the studio the next few weeks to go over that.
A little bit of a teaser there.
Super interesting stuff.
Yeah. Little pivot to key deal announcements. Rocket Companies is going to acquire Mr. Cooper Group. This is a Detroit-based fintech company. Rocket Companies announced a $9.4 billion all-stock acquisition of Mr. Cooper Group, a Dallas-based mortgage servicer, aiming to expand its servicing portfolio to 1/6 of U.S. mortgages following its recent Redfin purchase. So you see, again, servicing meeting the technology. In that transaction, the merger can create a servicing portfolio exceeding $2.1 trillion, encompassing nearly 10 million clients, which represents 1 in every 6 mortgages in the United States. Wow. Talk about scale. Yeah. The transaction is projected to generate approximately $500 million in annual run rate revenue and cost synergies. So very notable, and contributing to organic growth and increasing operating leverage. Why it matters: this is the largest lender plus the largest servicer. The combination of Rocket, the nation's largest mortgage originator, and Mr. Cooper, the largest servicer, forms a dominant player across both origination and servicing. So pretty interesting transaction. We continue to find these deals, these take private deals, becoming increasingly important in the private markets.
Yeah, absolutely. Another one we want to touch on is Castillo Hermanos is acquiring Harvest Hill Beverage from Brimwood Partners. Castillo Hermanos is a diversified multinational business group. They entered into a definitive agreement with Brimwood to acquire Harvest Hill Beverage. They have a suite of brands under their umbrella. A couple notable ones to cite are Sunny D, Juicy Juice, and Little Hug. We're going to kind of touch on consumer very briefly, but the deal is sort of strategic. We're going to talk about this a little bit on sort of the consumer segment of the podcast, but this is a strategic move for Castillo Hermanos. It's a family-owned business founded over 100 years ago, and they're really trying to bolster their U.S. presence. So bringing on this portfolio of brands, giving them a foothold in sort of the U.S. beverage market, gives them more scale and reach to not only different geographies, but maybe different demographics as well. I'm not too familiar with their current portfolio of brands, but I can imagine, if they don't have a U.S. presence right now, this is going to give them a good foothold there.
Absolutely. And we'll talk a little bit about sort of the strategy behind some of these consumers, bringing in to the broader brand portfolio and the distribution aspect of it too. But yeah, I haven't heard about Sunny D in a while.
Yeah, I know, right?
But, and Juicy Juice for that matter. But, Little Hug sounds like that might be a little bit better for you, maybe lower sugar type, beverage for kids. Also on the people moves front, PGIM Fixed Income hired asset-based finance head from Blackstone. This news was effective May 15th. They appointed Oliver Ninsenson as the head of asset-based finance. He will join the $837 billion fixed income manager from Blackstone Credit and Insurance, where he served as senior managing director overseeing asset-based finance investments. He was also previously a managing director at Credit Suisse for more than 8 years. In his new role, he will oversee the global private asset-based finance platform with the firm's $131 billion securitized product business. He will report to co-heads of the securitized product, Gabrielle Rivera and Edwin Wilches. So another important people move, one pivoting out of Blackstone to come to PGIM there.
Yeah, no, definitely an interesting people move here. We were talking about it before we started shooting today with just the broader trends. I mean, we're going to talk about it in our quarterly allocation report that's coming out soon, just the influx into credit instruments and strategies, and clearly a strategic move here by PGIM to hire someone from Blackstone Credit with a ton of experience to sort of be prepared for the shifts going on in allocations on the private market side, public market side as well, but definitely increased appetite in sort of credit vehicles.
Excellent. So that's really some of the key news, the people moves, the fundraising closed, and some of the deal transactions we saw during the week. Let's talk about the consumer space. So would you mind just kind of walking us through at a high level, kind of the introduction to the consumer sector?
Yeah, sure. So I'll give a brief overview of sort of what that entails, the different subsectors, and then I'll kind of dive into why it's so appealing to private investors. But
Excellent.
If you think broadly, the consumer sector includes businesses that market and sell goods directly to individuals like you and myself. Two major buckets: consumer staples. So you can think of these as food, toothpaste, cleaning supplies, things that you can't really live without. Essential products, steady demand, whether we're in an expansion or a recession, those are things that you're always going to be buying. And then consumer discretionary is sort of on the other side, where non-essential goods and services that sort of fluctuate given income levels, trends, macroeconomic environments. So these would be like fashion, electronics, luxury goods, and things of the like. Why this sector is appealing to private investors, it sort of spans a couple of reasons. One is sort of the brand loyalty and recurring demand aspect. So if you're able to establish a strong consumer brand, you're going to get a ton of repeat purchases, and you can really command pricing power as well, which is something that's really attractive to someone that might be maybe buying a business in this space or investing in a fund that buys businesses like that. It's a very powerful way to sort of drive valuation. Operational upside is another sort of key area of attractiveness to the sector. So many founder-led and mid-market brands sort of lack scale and digital expertise. So if you're a private equity investor, you can really add value here through better operations, digital marketing. Think about all the things that you can improve on the supply chain side to sort of improve the margins there. These are all things that private equity firms are drilling to get their hands on and improve. Consumer brands are also very scalable and global. With what's the distribution channels, DTC, social, you can really get global reach pretty quickly with the right strategies, and that can grow your sort of top line revenue pretty quickly. Think about thematic growth opportunities as well. Fast evolving trends, health, wellness, sustainability, all of these things are really opening new doors and new sort of customer avatars, if you will. And if you're an investor that can spot these early, you can really can have a lot of success. Exit optionality too is a key one to point out. So strong brands attract strategic buyers or IPO paths. We talked about IPOs last week. Consumer assets can really demand premium multiples if the brand loyalty is there. They can hit scale and sort of resonate with the buyers. And then we'll talk about this a little bit more quickly, but roll up and platform plays. So many niches within the consumer are still pretty fragmented. So the buy and build aspect is pretty appealing on the consumer side. Speaking of buy and build, Chris, I'm going to turn to you, just kind of talking about some common investment strategies if you're a private equity or a venture capital firm in consumer, what you could do there.
Sure. And just like on one point to make too before we move on to that is just you think about these exits, and we read about them in our news and we cover them from a Portco deal and M&A perspective at Dakota. But some of these transactions, we see these like $1 billion plus transactions. We talked about Poppy being acquired by Pepsi the other day. We talked about Spindrift getting acquired. Some of them are, often PE backed or maybe, minority investment from a PE firm. They're, as the article you just talked about in the news too, they're like often owned by these like families that have built the brand up. And, there's this really neat synergy across what their values are and how they're bringing to the market and all those things. But when they're acquired, if they're acquired by a strategic, you can get a very nice uplift in terms of multiple returns. So think 3x plus. And you think about in some of these really Hall of Fame examples, you think about like Bonobos, for example, which was acquired by Walmart a number of years ago. And they were kind of early onto that direct to consumer trend, basically look online, buying pants for, we've all bought those pants and being able to get fitted. And then Walmart comes along and realize, oh, wow, this is like a perfect opportunity for us to plug something into our portfolio. But at Walmart scale, paying a premium to them and then building out and distributing it through across their retail sites and their online platform changes the calculus for how much profitability that new business can contribute to their bottom line.
100%.
And you think about that aspect of it too. So strategics are able to look at it a little bit differently once they have the data and they're very informed. And in the consumer space, as you mentioned, with all the new technology, the platforms, Instagram, the social media aspect of it, what's selling in Target, what's selling good at Whole Foods, what's selling well on Amazon. These are such important data-rich areas for people to pick through and see what's the retention like, what are the brand loyalty values, like how are people interacting with it on social media. All that kind of is fodder for the strategics to get an early look at what these brands are doing and where they're excelling at. And maybe they're even able to bring in new types of consumers to their platform where they might have had gaps before. But pivoting to the common investment strategy. So we talked about a little bit about buy and build. So this would be buying a platform investment and then making add-on acquisitions on top of that platform. So this strategy involves acquiring a scalable platform brand in a fragmented category such as skincare, boutique fitness, natural snacks, for example, and layering on smaller complementary brands to drive scale, enter adjacent segments, or expand geographically. It works well in the consumer sector due to the abundance of niche players and the operational synergies gained by consolidating market, supply chains, distribution, all are real. And so having that aspect to it really makes this strategy kind of a more of lower risk proposition when you're thinking about how to drive value, how to drive growth for those types of transactions. Another one could be growth equity and brand acceleration. So a couple examples we talked about just a moment ago. This would be investors often back emerging consumer brands that have proven product market fit, strong customer affinity, but need help scaling. How do I get into the proper distribution channels? How do I get into Whole Foods? How do I get into Nordstrom and the like? Capital is deployed to build out teams, expand product lines, accelerate the marketing, move into new channels, as I mentioned, like the national retailers or international markets. These investors bring playbooks and resources that help founder-led brands grow faster and more efficiently. So an important part, and I know we're going to talk about a couple of firms that do exactly this in a moment, but just wanted to touch on that briefly. Another opportunity too would be in digital transformation and channel expansion. So this approach targets brands looking to evolve beyond their original go-to-market model, such as wholesale only or early stage DTC. Investors support the shift to an omni-channel strategy, helping brands expand across e-commerce, Amazon, social commerce like TikTok, which has become really important. You think about, actually, this trend is something that we're catching up to. You think about QVC back in the day, but really this has been going on in Korea and in other Asian economies all the time, where they were learning about new products and then buying them after they're engaging with maybe some social influencer. It's especially relevant today as digitally native brands balance online growth with physical retail presence. So people see a real need to have both presence in both channels. A fourth area would be thematic and trend investing. So firms often invest in brands aligned with larger cultural or lifestyle trends like health and wellness, sustainability, plant-based diets, like AG Greens, for example, or Gen Z consumer habits too. These investments are usually backed by a thesis around long-term demand shifts and brand authenticity. Successful execution requires spotting trends early and supporting founders who are deeply connected to their communities. I think one thing there to keep an eye on too is like, is it enduring? Is that trend really enduring? And will you see it? Like we talked about, kind of these better for you functional beverages on a couple podcasts ago, and ensuring that, is this going to outlast the next 1 to 2 to 3 years? And by proving that, that's important for strategics to get comfortable and thinking about how they can add it to their brand portfolio and diversify their brand mix there. And finally, this would be turnaround and brand revitalization. So some firms specialize in acquiring underperforming or legacy consumer brands with untapped potential. Through operational improvements, updated branding, new leadership, and modern marketing tactics, they reposition the business to regain relevance and growth. It's a value-oriented strategy that hinges on brand equity and execution. So often used in food, apparel, home goods. I think you can make the case too about the recent Walgreens transaction too, to an extent. While that's like more of a multi-site retail operation with pharmacy attached to it, there's definitely, with Sycamore being behind that transaction, a value-driven approach to how they rebuild that brand and drive growth from there. Alex, I'd love to talk about a couple of private equity firms that focus on the consumer area specifically, so our listeners can get kind of comfortable with firms that are in the market that are direct specialists in this space.
Yeah, absolutely. So one we can start with, sort of on the earlier side, is Forerunner Ventures.
Sure.
Early stage VC firm, definitely a brand name, no pun intended, when you think about consumer investing. So their focus is sort of the digitally native consumer brands and the commerce infrastructure, if you will. So the typical stage they invest in, they'll go as early as seed stage and as late as maybe Series A or Series B. Some notable investments. This part's fun because everyone's going to recognize these names and the other names that we're going to list. But Glossier, Warby Parker, The Farmer's Dog, Away. I love those suitcases, by the way. Outdoor Voices is another one. So their investment style, they have a ton of expertise in sort of consumer behavior and retail habits and how they evolve over time. And they really prioritize founders who sort of challenge the legacy model and can really disrupt whatever market that they're entering. Really meet consumers where they are, right? Especially online and mobile, which is, definitely a hot area where people can sort of buy these products. Forerunner, like I said, is probably one of the most respected early stage firms in sort of the consumer space. Another name you want to call it is sort of Insight Partners. They're more growth stage venture capital. They also do some sort of buyout investments from the PE front. They have a software tilt, but they will back sort of the high growth consumer tech and direct to consumer platforms. So late stage venture, growth equity tends to be their sweet spot. Some notable investments: HelloFresh, Calm, Shopify, BlaBlaCar, definitely more the platform types businesses. So they're not consumer exclusive, but they're really bringing enterprise level scaling experience to these consumer tech businesses, which is definitely important on the operational side, providing that operational excellence and really growing these businesses into like true institutions. VMG Partners is another firm we want to call out. This is a growth equity firm. So their focus is investing in emerging consumer brands with sort of strong emotional resonance and brand equity. We talked about how having a strong brand is so important. That's kind of where they're focusing on, identifying those companies before they become these like pure household names. They've had some success because I'm going to list off some names and I'm sure everyone's heard of these before. Kind Snacks. We have a ton of Kind bars upstairs. Native, Spindrift, Justin's, almond butter and peanut butter, Perfect Snacks. So their investment style is brand first investing. They want to invest in the brand and they want to provide hands-on support across marketing, operations, and retail expansion. VMG sort of has this reputation for building iconic category defining consumer products in sort of the food and beverage and beauty space as well. A couple more here. TSG, consumer, private equity firm. Their focus is on branded consumer products and retail businesses. They will do some minority sort of growth equity investments, but also focuses on buyout investments, firms and companies around 50 million in revenue or higher. Some notable investments here: Stumptown Coffee, Revolve, Brewdog, Pabst Blue Ribbon, and Backcountry. So their investment style, they really seek strong brand DNA and high customer loyalty. They have a ton of experience solely on sort of premium consumer businesses. Catterton, private equity firm that was formed via partnership with LVMH and certain Group Arnault. Their focus exclusively consumer across 6 main verticals, which they define as fashion, health and wellness, food, beverage, and pet care. Typical stage for them: growth equity. Will do buyouts as well, sort of across small, mid, and large cap. Notable investments for them, I'm sure you've heard of all of these as well: Peloton, Equinox, Birkenstock, ClassPass, Just Food for Dogs. So their investment style, they're looking really for global reach and luxury brand alignment. If you think about like who the most influential consumer focused private equity firms are, this is probably one of them. One more we want to call out is Kainos Capital, private equity firm focused mainly on food and consumer products, especially with like a health oriented tilt. They're making mainly control buyouts. We'll make some non-control growth equity investments as well. Notable investments from them: Nutrisystem, Kettle Cuisine, Ferrara Foods, Old Thompson. I think their investment style, they're definitely operationally focused, really trying to shore up the supply chain, the marketing, the manufacturing, the distribution. That's kind of their bread and butter and how they can scale these businesses that they invest in. And that's going to kind of wrap up that part of the segment, really hitting on who the key players are.
It's interesting like hearing you go through that too, because each of those different groups, you can very clearly see it's a clear distinction amongst all of them. So where they focus, the stages they focus, the types of businesses they're buying. There's a lot in kind of the food and snack categories, health and wellness, cosmetics, and pet. All of these, some of them. And in the last example too you provided, they're buying, legacy brands that have the potential to reaccelerate those. But then on the other hand, you have groups like Forerunner that are buying these new emergent brands that are really catching wind and taking share in new categories as well. And I would also call out to firms like Prelude and Sky, which are some of the other ones that are doing similar focus to. Sky is actually invested in Truff, which is like the premium hot sauce truffle goods. And when you think about all that's going on, these are some of the fastest growing segments in the economy, but having their own spin on it in their own place where they're investing in that specialization too. If it's unlocking retail distribution, if it's, basically figuring out like sales and marketing efforts, direct to consumer strategy, all these things, it's very clear focus on, bringing value add toolkit to drive value for these brands.
And you can kind of hear the names I was listing on the portfolio company side: Away, Kind, Peloton, Equinox, all these names and things that you can kind of touch and feel. I think that's a pretty attractive aspect of this segment as well. Sometimes if you're looking at maybe a middle market buyout firm that's buying these industrial businesses that you've never heard of and do something that you can't really wrap your mind around, I think what's appealing to this is that, okay, I know what Peloton does, I know what Birkenstocks are. You can kind of touch and feel these assets that they're buying, and I think that can get people across the line a little bit easier. They have a little bit more comfort and understanding of what they're buying and why.
Yeah, and you, in a way, become your own brand ambassador too. Like we were talking about in our office too, having the snacks upstairs, and being an investor in early days when we're picking up all these kind of new brands and we're all talking about it in the office around lunchtime. We're like, wow, this is really good. I like this. I don't like this. Things turn all the time, but there's those like the Kind bars. There's ones that just stick and they stick around, or Spindrift, for example.
Yeah, do you want to touch on some of the trends that are going on right now?
Yeah, absolutely. So one important trend is omni-channel acceleration. So a shift from pure direct-to-consumer to hybrid models, so combining online, retail, and wholesale together. Brands leveraging Shopify, Amazon, TikTok, and physical retail simultaneously. Investors now look for channel diversification, not just D2C flashiness. So, diversifying their approach, their distribution, attacking different consumers where they are. Another one is the rise of health, wellness, and self-care. So consumers prioritizing mental, physical health fueling demand for clean beauty, supplements, fitness, sleep products, plant-based nutrition. Wellness is no longer a small part of the market. It's a lifestyle category as its own. Another third trend is sustainability and mission-driven branding. So I think Cotopaxi is like a notable example there, but ESG-focused products gaining share, recyclable packaging, carbon-neutral supply chains, cruelty-free testing. This is really catching storm with younger consumers, especially Gen Z. Yeah. Expecting brands to stand for something. So I want to buy this and invest in your brand. I want to be here for the long term, but I also want to see everything meet the values that I embrace and I think are important to me. A fourth trend to call out is personalization and consumer data. So data-driven targeting, which equals more efficient consumer acquisitions and loyalty. AI and analytics powering product recommendations, skincare routines, wellness plans. This is all about owning the customer relationship and data. It's now a competitive moat. So a little bit more nuance there, but again, coming back to kind of how data rich this sector is, understanding this trend is extremely important. Another thing to call out is the premiumization and affordable luxury. So I guess you have sort of these aspirational brands, but then just below that too, you have things that people are always coming up and wanting to buy and have the ability to buy. Yeah. And it's kind of becomes a special thing. So even in economic downturns, consumers still spend, just more selectively. So brands offering elevated experiences at reasonable price points are winning. Examples include specialty coffee, craft spirits, designer style, D2C fashion. These are smaller ticket items, but they make a difference in our daily lives. You mentioned Stumptown Coffee. I know you're a big coffee connoisseur, so that's one where a couple extra bucks, maybe it gets the engine going, but at the same time, like it's a better quality product, and it says something about you at the same time. Another trend to call out. Fragmentation becoming a roll-up opportunity. So many niches remain fragmented. So think about wellness studios, pet brands, ethnic beauty, pet particularly. Seeing a lot of this in the vet pet clinics. Yep. The great environment for PE platforms plus add-on strategies there. And then finally, social commerce and creator-driven brands through the means of TikTok, Instagram, influencer partnerships driving discovery. Some of the fastest growing brands now come from creators with built-in audiences. Distribution channels increasingly shaped by community and how many likes they're getting on social media. Yeah. So people learning about things earlier and often. And I think that was kind of the case with Poppy and some of the influencers behind building that brand early on and through a partnership approach. I did want to also talk about the risk factors in the consumer space to watch out for. So unsurprisingly, it's an economically sensitive area to invest. So discretionary categories particularly are hit hard during downturns, particularly in the apparel, restaurants, and travel segments. So inflation can also put pressure on margins and alter spending habits. One thing we talked a little bit about earlier is this notion of consumer trend volatility. Mm-hmm. So are things enduring? Do they last? Consumer preferences can shift quickly. What's hot today might not be necessarily the thing to back tomorrow. One thing that kind of came up during COVID was the Crocs thing, that everyone started buying Crocs again that were, it seemed to last. I'm not sure if that's still the thing.
Didn't last for my friends, that's for sure.
Channel disruption. So this is a heavy reliance on single channels, either D2C or Amazon exclusively. So changing algorithms, platform fees, customer acquisition costs can destabilize growth. So definitely important to think about, but mitigating factor there being that diversification strategy we were talking about earlier to be kind of an omni-channel presence. There's also customer acquisition cost inflation and digital marketing fatigue, where customer acquisition costs continue to rise across Meta, Google, TikTok. As ad spend becomes less efficient, brands must rely more on retention, loyalty, and organic growth to fuel that. So you can't just spend your way out of growth. You have to find, retention and recurring demand from your existing customers. There's also a lot of supply chain and margin pressures that can come about, particularly through trade. This is a very big topic du jour right now with the tariffs, but anybody that might be more domestic oriented and manufacturing in the US might be a little bit more insulated this, but anybody that might be in the apparel segment or home furniture segment might be thinking a lot more about this today, perhaps even the cosmetic industry too, where they might be testing things and doing things overseas. And then there's also the overvaluation and hype risk. So many consumer brands saw inflated valuations during the DTC boom of 2020, 2022. But investors are now more cautious and they're focused on shifting to profitability, not just growth. What are some of the interesting consumer funds that we've come across with Dakota recently in the market?
Wanted to pick out two interesting ones, maybe on the smaller side,
Sure.
that people maybe should be aware of. One is Simple Foods Ventures. They are on their second fund, and they completed a first close last month. They're at 15 million. They're targeting 40 million for a final close, hopefully by the end of the year. They target companies, again, kind of in a niche that we spoke about, but in the food and beverage space, but for the better for you alternatives. So we talked about like health and these better for you products not becoming just like a niche, but like lifestyle, health, and wellness becoming like an actual standalone category. So they're focusing on sort of these better food and beverage alternatives. So if that's something you're interested in, Simple Foods Ventures. Another one we want to call out is Sugar Capital. This firm was founded by Brian and Lisa Sugar. They founded Pop Sugar, which is a very popular blog that, talks about blogs, markets, different sort of consumer brands and products. They're a seed stage venture firm. They focus on investing in technology-driven commerce platforms and emerging consumer brands. Their investment philosophy centers on supporting software and services that help these SMBs and enterprises scale, and also backing consumer brands with the potential to become household names. A couple companies that they've invested in thus far in previous funds, Feastables, which is
Sure.
Mr. Beast's chocolate brand, and Grunes, which is an interesting one that I've actually tried a few times. They are sort of the gummy version of Athletic Greens. A couple other notable investments they've made as well, but they're on their third fund. So those are just a couple that we wanted to call out on the consumer side. To wrap up, I'll just kick us off with a couple funds and markets, some sort of key action items. Cathay Capital and Sanofi just launched a $275 million drug development fund. So Cathay Capital and Sanofi, the pharmaceutical company, they're joining forces to launch this $275 million fund to support pharmaceutical innovations in China. So this innovation fund will pump capital into clinical stage innovative pipeline drugs and relevant industry opportunities in China. The primary objective is to expedite the commercialization of drugs in development so they can be introduced to different global markets. It represents the expansion of partnership between Cathay Capital and Sanofi, which started in 2020 when the firm actually invested in their own venture capital platform, the Cathay's Innovation Fund. Cathay Capital has been around for a while. They were founded 15 years ago. They've raised over 23 funds at this point and have an AUM of over $5 billion. And them joining forces with a pretty significant pharmaceutical company, they'll definitely make some waves there and maybe hopefully find the next big drug. And then you want to touch on the NGP fund?
Yeah, sure, absolutely. So we talked a little bit about royalties earlier, but this one fund is being a specialist in the energy space. NGP Energy Capital has committed to investing $100 million in New Wing Resources, mineral and royalty acquisition platform. The platform Wing Resources 8 launched with support from NGP Royalty Partners 3. It will exclusively target opportunities to buy mineral and royalty interests focusing on the Permian Basin, so one of the core basins in the U.S. NGP filed its fund with the SEC in January, indicating it expects fundraising to last more than a year. Dakota data shows that the fund secured $50 million from the Kentucky Teachers Retirement System and $100 million from the Teachers Retirement System of Texas. The firm was established in 2016. Wing Resources has evolved into one of the largest private holders of mineral and royalty interests in the basin, with a portfolio now comprising over 3,000 horizontal wells across Midland and Delaware basins. NGP has been involved in more than 300 transactions with over 190 companies in the energy sector and has committed roughly $17 billion through its funds since its establishment. So a scale player there in the mineral space, one to keep an eye out for. But I think that's a wrap for funds and market. Just pivoting quickly to upcoming Dakota events and product notes. We've got a number of Dakota Cocktails events, so we're on the road. We'd love to see everyone in person. Chicago, April 22nd. Tampa, April 29th. Los Angeles, May 6th. And then we're hosting our Dakota Research Conference on June 17th, which we have an exciting lineup of fund managers presenting. So it's open to the allocator community that are interested in learning more about funds in a condensed half-day investor event in New York City at the New York Athletic Club. We're really excited about that event coming up, and there'll be more online with a website and invitations to go out next week coming. Finally, we have the Dakota Research webinars, which are walking through all the platform where we get this information, the data that we provide to our clients today. Please check it out. They're done live, and you can also add questions just like this this podcast. And so we can get more information to you if you have any questions on that. Next week, episode teaser, talking about.
Yeah, next week we're going to talk about major trends in the investment industry, things like consolidation, allocation trends, things like that, kind of just taking a step back a little bit, provide a little bit more of a macro focus, but should be exciting.
Absolutely. And there's so much going on in the space, the rise of alternatives in wealth management platforms, the consolidation of RIAs, all the changes that we're talking about day to day. But I think we need to do it in a concise fashion so people can really track what's going on and make informed judgments out of that.
Looking forward to it.
Alex, thanks so much for the time today. Appreciate it.
Yeah, thank you.
Thanks everyone for joining us. Please join us for the next Dakota Research Podcast. Have a good day.
Hello, everyone. Thank you so much for listening to the Dakota Research Podcast. All of the information we cover today and much more lives in Dakota Research, our private fund due diligence database. If you're not familiar with Dakota Research, we really encourage you to go onto our website and book a demo so you can check out all of the recordings, all of the data, and all of the information we covered, plus much, much more. Again, thank you so much for listening in today. Go to our website and book a demo of Dakota Research today.